Okay, today I show you what stocks I have and why I have them. But knowing what actual stocks I have is not as important as knowing why. This is a really important video, and I am going to bust a huge myth about stocks that a lot of people have. I am not an investment counselor, and I'm not telling you to copy me or do anything I say. Investing has risks, so do your own research. Crashes will happen. They always do. It's roughly about every 5 years, and it's part of the normal healthy market cycle. So don't freak out. Don't have that stop you from investing. In fact, when it's down, that's the best time to buy. And it always comes back stronger than it was before. It always has. Think of it like trees and everything looking dead in the wintertime. But then spring comes and everything grows taller than it was before. A crash is not a bad thing. It's a sale. It's like the best time to buy. Think of it like your favorite product on sale for half off. The most millionaires were created during the Great Depression. When the market crashes, and it will, there are two things to do. Buy ETFs or don't do anything at all. All you have to do is wait. It may take 3 years, who knows, but it's an exciting time when the market crashes. I know it sounds counterintuitive, but it's an exciting time because the arrow is being pulled back, and the further it gets pulled back, the higher in the sky that arrow will fly. A crash means the market is about to soar higher than ever before. It may take 5 years, who knows, but it will, and that waiting is the nature of investing. There's a difference between trading and investing. Investing means you're patient, and those are the ones that win in the long run. The worst thing you can do is sell during a crash. That's a good way to lose half your money. But if you didn't sell, let me give you some worst case scenarios. This might help put you at ease. If you invested, say, $100,000 the day before the dot-com bubble burst in March 2000, you would have almost $900,000 today. That was the worst day you could have invested, and you'd still have $900,000 today from $100,000. If you invested $100,000 the day before the 2008 housing bubble burst, that's, again, the worst time to buy because everything is at its absolute highest, you would have $700,000 today. Or if you bought a $100,000 stock right before the pandemic crash, you would have $250,000. Those were the worst possible days to invest when the market was at its highest right before the crash. So let's say you invested the day before the big 87 crash. The next day, your stocks would only be worth half what you paid. But if you had simply held on to them, you would have over $4 million today. Again, those are the worst possible days to invest. Time and patience are your strongest allies. So when the market crashes and the media says, "This time it's different," which they always say, laugh at them. They always say, "This is the end of the stock market. The dollar could become completely worthless. The economy could totally collapse." Remember, they've always said that. At every time. And it's happened 27 times in the last 100 years. And each time, the market came back stronger than it ever was before. Warren Buffett always says, the crowd's fear is your discount. Again, it's a sale. Half off. Go buy. Stop wasting money on status symbols. If someone bought an iPhone 10 years ago, which is what everybody does, they buy an iPhone because it's the thing to get, right? If you bought an iPhone 10 years ago for $1,000, it would basically be worthless today. You're lucky if you get $20, $30 for it. If someone had instead bought $1,000 in Apple stock, today, 10 years later, it would be $13,000. So that's the difference between consumerism and investing. Stop spending money on big screen TVs, giant flashy SUVs and pickup trucks, off-road vehicles and boats and high-end outdoor kitchens and VIP tickets to sporting events and double latte espressos at Starbucks every day. In 10 years, that stuff is worthless. You could have invested it and been financially taken care of for the rest of your life. Okay, so let's get to investing. Two of the biggest mistakes people make in investing is they buy stocks from individual companies oh, Apple's really big, so I'm going to invest in Apple. And they'll all want dividends right away, so they Google what the companies with the highest dividends are. Do not get the ones with the highest dividends. That's a danger sign. Companies often have high dividends when they're in trouble. Don't be greedy. Get safer ones with more stable rates. Keep in mind, it's not just a matter of what stocks you have, but how much of each one, because some are riskier than others, so you want a good balance in there. I have some individual companies that could go big and make a lot of money, but like I said, that's riskier and shouldn't be what you get when you first start with investing. The best, safest thing to start with is index funds or ETFs, which are a collection of the top companies in one bucket. So if one goes down or goes bankrupt, you have the rest to keep you afloat. So my portfolio is about 55% diversified buckets and 45% individual companies. And I know I said investing in individual companies is riskier, and that's true if you go after the big flashy ones that you think are going to go big and make you lots of money. Half of my individual companies are not that kind. Some are, but half of them are actually the opposite. They are the companies that produce toilet paper and toothpaste, so no matter what the economy does, those companies will help keep me stable. So half are higher risk, could go big stocks, and half are safe, stable stocks. I have 40 holdings. That means I have 40 different investments, but you definitely don't need that many. You can have just one, like VOO or SPI, which represents the top 500 companies, otherwise known as the S&P 500. Or if you only want dividends, you can have SCHD, which represents the top 100 dividend companies. But like I said in the earlier video, wait till you actually get to retirement age to get into the dividends. Right now, you should be getting into growth stocks to make as much money as possible so you can invest those into dividends later on. What a lot of people do is they have 3 or 4 different stocks. One for high gain stocks like NASDAQ, which focuses on big fancy tech companies. You can make a lot of money on tech, but it's also very volatile, which means you could also lose a lot. So a lot of people only have like 1/3 of their portfolio in high risk stocks. At least have them in ETFs so the risk is spread out and minimized. Then the second third is broad market index funds, which represent like the S&P 500, like VOO or SPY, which is more balanced than the tech-heavy NASDAQ and therefore not as risky. And then a third part would be a much safer and boring stuff like consumer staples or treasury bonds. Growth stocks give you considerably more money over time than dividend stocks, also known as income funds. You know, dividends are an income, and it is taxable, by the way. Okay, so what I'm doing is right now I have more growth stocks than income stocks, so I can get as much money as possible over the next 10 to 20 years, and then sell half of them and use that money to buy dividend stocks, so I have automatic checks coming in every month for the rest of my life for my retirement. I hate that word. Anyway, I have some dividend stocks right now, but not very many. What a lot of people do is they have them set up as drip accounts, which means they are dividends that when the dividends are paid, they're automatically get reinvested into the same company they came from. So each month your dividend payments grow bigger. But since growth stocks give you more money in the long run, what I am doing right now is instead of having the drip turned on, I take those dividend payments and I put them into growth stocks. It's good to have some dividend stocks, even in the growth phase, because they are more stable. When the stock market goes down, they can help pay your bills during the hard times. Now, being that this is a health channel, for those of you who are still around watching this, so what's this got to do with recipe videos? An obvious question people will have is, how can you invest in oil and stuff like that? And that brings up one of the biggest misconceptions about the stock market. So let's get that right out of the way right away. When you buy stock, you are not giving money to that company. That's what people think. When you buy $1,000 worth of Microsoft, that money does not go to Microsoft. They get $0 from you. When a company issues shares, it is essentially saying, give us money now, and in exchange, you'll own part of this business forever. That money goes directly to the company. Okay. The first time when you sell a share, it goes right to the company. It can be used to build factories, hire employees, develop products, pay off debt, or expand. But after that, if you buy 100 shares on the stock market of Microsoft or whatever, the company gets nothing. Let's say Bob Smith buys 100 shares. At some point, he decides to sell them. So now 100 shares are available, and I come along and want to buy 100 shares. I'm buying them from Bob Smith, not Microsoft. It's simply a transfer of ownership between investors. The company doesn't receive a penny from those trades. The company didn't even know the transaction happened. Does the company benefit? Well, kind of, but indirectly. Let's say a rare Ferrari is for sale, okay? The collector pays $5 million. Ferrari, the company, doesn't receive the $5 million. The seller does. Owning a stock isn't the same thing as endorsing every action or opinion, executive or product of a company. I shop at grocery stores. Sure, they have apples and lettuce, but they also sell cigarettes and alcohol and candy bars and soda, frozen pizzas, and all kinds of junk food. Does buying bananas therefore mean I endorse everything in that store on every shelf? Of course not. Should we stop buying smartphones because mining rare earth metals has environmental impacts? Should we stop using concrete because cement production emits CO2? I drive on highways. Some people use those highways to go to church. Others use them to rob banks. The highway isn't making a moral decision. It's infrastructure. Investing is not a moral purity contest. It's ownership in the economy. You use electricity every day. Do you know where that electricity comes from? Do you? Depending on that day's demand on your grid, today your area could be switching into electricity coming from coal or natural gas. Tomorrow it's tapped into nuclear or hydro or solar. You don't know where that power is coming from. But what you do with your life while using that electricity is what matters. Your house could be powered by electricity from a coal plant this week, while you use your computer to create an anti-coal campaign. Do I think we should waste oil? No, but today almost everything in modern civilization depends on petroleum in one way or another. Fertilizers, ambulances, fire trucks, airplanes, tractors, hospital equipment, shipping, plastics, asphalt, you name it. Wishing oil away doesn't make those needs disappear. We drive cars that run on gasoline that comes from oil. That doesn't mean we have to like it, but if it gets us to where we need to go, then that's what we do. Investing and consuming are two different things. Again, this is the biggest misconception with the stock market. As weird as it sounds, they are not directly tied to the company. When a company's stocks soar or plummet, it often has very little to do with the company itself. It has to do with the fear or greed of buyers and sellers and internet hype. The company itself could be doing just fine, but some clickbait YouTuber could make up some conspiracy theory and create a wave of fear and panic, triggering a massive sell-off, or vice versa. A company could be in trouble, but people think it's going to be the next breakthrough and buy stocks like crazy, making it heavily overvalued until people realize the company itself isn't really worth that much. So when stocks suddenly go up or down, ask yourself, did the actual business change, or did people's emotions and opinions of that business change? Those are two very different things. The stock market doesn't measure value, it measures people's opinions and emotions. And eventually the truth comes out. That's why you need to be patient and not freak out every time something goes way up or way down. A true investor is in it for the long haul, not some get-rich-quick fad that all the sheep are following. I don't try to predict which one company will be the next big winner. I build multiple engines. One engine produces monthly income. Another focuses on AI and technology growth, and another owns America's strongest companies. Another profits from energy infrastructure. Another owns businesses that sell things people buy no matter what the economy is doing. And the goal isn't to hit a home run with one stock. It's to build a machine where the many parts work together and continue compounding over time. Compounding is what makes you successful in the long run. Okay, I know, shut up, Marcus. Just tell us what the damn stocks are. That's like sick people saying, just tell me what to take. Not asking why they got sick and what they should stop doing so they don't get sick again. But okay, remember, you don't have to copy me. In fact, I don't want you to copy me. I bought these stocks when things were lower. Right now, some of these are overvalued, so now's not a good time to buy some of the ones that I have. Do your own research. Remember, I've been doing this for some time and have a lot of different stocks, so you only need a few, or even just one. All right, here we go. The one that I have the most is SPMO. It's a relatively new one that not a lot of people have heard about. It's a collection of the top 100 momentum companies, meaning companies with the most momentum, the ones with the most thrust. And this list gets constantly updated twice a year. And that's really cool. Then I have O, Realty Income, which owns thousands of commercial properties that generate rent. It's reliable monthly dividends from real estate without being a landlord. Next up, there's JEPI, JP Morgan Equity Premium Income ETF. High monthly cash flow while still participating in some stock market growth. Then there's Palantir, PLTR Technologies. This one's a higher risk one, but with the potential to outperform everything. It's AI-powered software used by governments and businesses to analyze massive amounts of data. And of course, Microsoft, MSFT. It's a cloud computing and artificial intelligence leader, decades of growth potential. ARCC, Ares Capital. This one lends money to middle market businesses. It's high dividend income from private business lending. Then there's OBDC, Blue Owl Capital Corp. Dependable monthly income from a business development company that lends to established private companies. Next up, EPD. This operates pipelines and energy infrastructure because energy usage is the toll road, which is paid regardless of oil prices moving up or down. And of course, NVIDIA, the leading supplier of AI computing hardware, and its direct competitor, AVGO, Broadcom, for making chips. And these are used by Google, Meta, OpenAI, ChatGPT, and Anthropic. So Broadcom is a huge one. QQQ tracks the NASDAQ 100, exposure to the world's biggest technology innovators. CAIQ. This one is interesting. It has 17% dividends from technology companies with a built-in 1-month crash buffer. That's really cool. Then there's CF. CF Industries produces nitrogen fertilizer because agriculture is essential and fertilizer demand isn't going away. BRKB, Berkshire Hathaway, Warren Buffett's holding company designed to survive just about anything. It has $400 billion in cash reserves. VDC, Vanguard Consumer Staples ETF. This owns companies that make everyday household products people buy even during bad times. ET, Energy Transfer, Energy Transportation Systems, high income from essential energy infrastructure. Main Street Capital Business Development Company, investing in smaller businesses for monthly dividends. VTI, Vanguard Total Stock Market ETF. This owns nearly the entire U.S. stock market, broad diversification across the American economy. VGT, Vanguard Information Technology ETF. This one invests in leading technology companies for long-term growth. OVL, Overlay Shares, Large Cap Equity ETF for growth and income. It's a good balance plus some crash buffer. UTG, Reeves Utility. This invests in utilities and infrastructure companies. It's defensive income from essential services like electricity and water. QQQM, this is a lower cost version of QQQ. DGRO, this one invests in companies that consistently raise dividends. KMI, Kinder Morgan, North American Natural Gas Pipeline. There is a growing natural gas demand, especially with data centers who use their own turbines and don't rely on the grid. TYG, Tortoise Energy Infrastructure, high income from pipelines and midstream energy assets. RKLB, this is Rocket Lab. I just have a little bit of space rocket industry in there because who knows. So it's about 1/3 total growth stocks, 1/3 are dividend stocks, and a little less than 1/3 are like half and half, they're 50-50. So to summarize my portfolio, these ones are my income engine. They stay pretty steady whether the market goes up or down. These ones are my growth engine. I have these to grow as much money as possible over decades. These ones don't really have dividends, and these ones are my stability engine companies that should continue making money throughout almost any economy. Again, I'm not trying to predict one winner. I'm building multiple engines that serve different purposes. Growth builds wealth. Dividends pays the bills, and stability lets me sleep at night. And by the way, this money does not go into my personal account. In fact, I don't even officially own any of this. I created an asset protection LLC in another state, so no one can come after it. My house is paid off, but I don't own it. That's owned by another company. If you have valuable stuff, it's wise not to be associated with it so people can't come after it. Asset protection is another important consideration, but that's for a whole nother video. You don't want to personally own much of anything. If someone in your family gets in a car accident, the last thing you want is for lawyers to come after your house, your business, and your life savings. Everybody wants money, and they want a lot of it, and they want it fast, but they don't think it through. Just like your health, your loved ones, and anything else of value in your life, protecting it is just as important of an investment as the investment itself. So many things to talk about. There's really no end to it, but I try to give you the basics of what is needed to be healthy and to minimize the stress in your life so you can actually live life while you're here. Remember, the most important thing about investing above everything else is patience. The market will go down before it goes back up. It always does, at least once every 10 years. And it's almost never because the companies are doing bad. It's because the people holding the stock are emotionally unstable and selling out of fear and hype, which is the perfect time for real investors to grab great deals when things are down. Benjamin Graham described it pretty good when he said, in the short run, the market is a voting machine. It's a popularity contest. And in the long run, it's a weighing machine based on actual business results. Warren Buffett said the stock market exists to transfer money from the impatient to the patient. The crowd's constant running back and forth creates opportunities for investors who are willing to think in terms of years instead of days or months. There's a difference between trading and investing. Traders lose money. Investors are usually the ones who win big in the long run. Well, I hope I'm helping you, or at least I'm helping better the understanding of things that you've always wondered about, but never really got a clear answer about because everybody wants you to pay them for this information. This is my gift to you. Live long and prosper.